Jim, we're in the middle of the deepest recession in more than 80 years. Unemployment is headed above 20%. Consumer spending has collapsed. Yet investment grade debt, I checked this morning, is up on the year. Bonds are down just 12% in the high yield market. Is credit properly priced?
Well, listen, great question. I would say that the breadth of credit today is wide and extreme. And as you saw in that middle of March, that week of March 23rd in particular, 4 or 5 days before that, the markets really seized up. The CP market, the money market, the IG market, and in response to a tremendous amount of stimulus by the Fed, tremendous moves by the Fed and Treasury, they really unclogged the IG market, the investment grade market. And so you saw a tremendous amount of issuance from Wells Fargo, JP Morgan, Procter & Gamble, and some great companies. So certainly the IG market and the spreads of where that got issued, that was quite attractive at that point in time. But certainly we are in a 6, 12, 18-month economic recession where all credit's being repriced, some probably attractive, some not attractive right now. And you need to have a wide toolbox to really analyze that. So some credits are fairly priced. A lot of credit probably is well ahead of itself, where you have market fundamentals still very, very challenged, notwithstanding the tremendous amount of federal fiscal and monetary stimulus.
What are those spots where the market is ahead of the fundamentals?
Sure. I think when we see the market run, we oversee a $200 billion plus credit platform, and really the largest and broadest non-investment grade alternative credit platform on the planet. So when we think about the world right now, certainly I look at it in 3 chapters over the next 18 months. I look at it as the first chapter, which we saw was dislocation, really markets seizing up and only the highest quality assets receiving a bid and interest. The second is what I would call capital solutions, different types of funding for growth companies. And the third is the distress market. So when you think about those three areas to put capital to work, and then you overlay a variety of whether it's a V shape, which is extremely unlikely, a U shape, or an extended L, certainly, we were quite quick of foot on the dislocation part. That was attractive. You did quite well providing capital to great American companies, United Airlines, Airbnb, Expedia, Cimpress, which we did in the dislocation and certainly in capital solutions. But the distressed angle, I really believe that there's really going to see unprecedented damage to the economy. Certainly we're seeing with the unemployment numbers that you mentioned, but certainly I think it's my view and our view as a firm that while we are wading our way into the distress universe, there is plenty of time when one looks at the real behavioral dislocations of what's going on. So distress is some time to come. And what I may also add, Eric, is what the Fed has done with their stimulus is they've helped the highest quality investment grade companies, but there's many, many more middle market companies, sponsor companies, a lot of the asset-backed businesses, which have still yet to recover and are in very, very poor shape overall.
So what you just said prompts many questions for me. But since you ended on the Fed, Jim, does the Fed draw the line at fallen angels, or do policymakers go deeper into junk territory and possibly even into structured finance?
Well, as you point out, I think while it was not a surprise what the Fed did on the primary and secondary credit facilities, as you point out, the inclusion of the fallen angels, former investment grade companies that had fallen to non-investment grade or junk, and the inclusion of the high yield ETFs certainly took the market by surprise. I'll also add that even though those facilities, very creative and well structured, have been announced, they really haven't even been put into practice yet. And as you point out in the beginning, there's been massive investment grade issuance. So, certainly this is a new area for the Fed. You've had central banks around the globe take even more dramatic actions. What they did in Asia and Hong Kong in the financial crisis in Asia, they went and bought equities. I suspect while Powell has done a tremendous job and they've got lots of what-if scenarios that at this present time, I don't see them expanding beyond what they've done in the IG market. With regard to the asset-backed business and the asset-backed facilities, TALF was a great success in 08, 09. And certainly today, they've really just announced that the AAA application of TALF in terms of the AAA securities. We would argue that if the Fed expanded that facility, they would really, because of the evolution of the markets and how many companies finance through asset-backed franchise finance, fleet finance in terms of some of the car industry, I think that would touch a lot more American companies, which need liquidity right now. I mean, what you're describing, what we're talking about, it just shows once again where credit really is the lifeblood of the U.S. economy and the global economy. And companies can't operate without liquidity. And again, the great companies, the great American companies that we've helped finance over the last 8 weeks, we're just putting capital into those companies so they can, adjust their business plans appropriately.
So, are you or are you not in Howard Marx's camp bemoaning the amount of Fed liquidity that's competing with private capital?
We don't spend our time. I mean, I think that these were, you have to tip your hat to what the leadership of the Fed and Treasury have done. The most unique economic crisis we've ever been faced globally, and the response has been thoughtful. It's been swift and decisive. So that's good for America. That's what we care about.
You mentioned, if it wasn't you, your colleagues on the Apollo conference call on Friday mentioned that the firm had lightened up smartly, luckily, doesn't really matter, on retail and energy before the pandemic. What industries, Jim, are effectively no-fly zones right now?
Well, I think, that question, I mean, you really have to understand business models in this environment. And in the middle of March, it was this massive dash for cash. Many large companies access their revolving credit facilities at the banks. And from our perspective, when we overlay those economic scenarios, you want to have companies that you believe have the liquidity to make it through over the next 12 months.
You know what I'm getting at, though, in a macro sense, is there value left in retail? Is there value left in energy with crude at $22? Well, are there any other places? Apollo has been relatively big on, directly and indirectly in airlines. Do you rethink those industries because the business models are so challenged in an economy where huge swaths of what people do just aren't happening anymore?
Well, you got to separate all this. I mean, certainly you have industries that had secular headwinds before they came into this crisis. Certainly what was going on with the global players in energy in Russia and Saudi Arabia and their objective of really impacting U.S. shale producers, that had a secular challenge before we even got to this business. Obviously, retail has been well published in terms of their secular challenges. So, for us, when we look at credit, while there are a variety of businesses that have been directly impacted, obviously a company like Expedia, a company like Cimpress, a company like UAL, which we provided capital to, we believe those are great, robust American franchises that will survive. Now, certainly, I think that we've been thoughtful about our approach to retail and energy over the last several years. I think it's in credit, loans and bonds, they don't go north of par. They usually stay right at par, but you can have downside to zero. So it's different than the equity market. I think the bigger question you're bringing up right now, though, is really equity versus credit. And I think in this environment, when you're getting paid a handsome coupon, when you have a structural protections, it's much easier to be fleet of foot. As you know, we put almost $50 billion to work in the beginning of the year, $40 billion in the first quarter. And that's because of our ability to really analyze these capital structures, separate the ones that don't have the secular headwinds, but actually have a business model. And if you can do so in performing credit, get a great coupon. And the reality is, in that first stage of the market sell-off, that dislocation that we talked about, there were many companies that I would argue we're all going to be impacted, but we're less impacted.
Jim,
and those are the ones that make sense.
Jim, every CLO manager I talk to says something along the lines of the following: they'll be fine. How, if the economy is in shambles, if downgrades are multiplying, if bankruptcies are accelerating, is it that vehicles loaded with leveraged loans are fine?
Well, there's two parts to that answer. One is about the structure, and then the second is what's underlying. So, I would say that if you look back at this period of time versus '08, in '08, the crisis was really at the intersection of the commercial banks in the U.S. and residential real estate. Today, the intersection of the crisis, beyond the obvious entertainment, lodging, travel, will be an intersection of structured credit, probably commercial real estate, and some secular headwinds in a variety of industries like retail. So as a CLO manager, the benefit that you do is you have capital that's arguably locked up. You have liabilities that are fixed for many years.
Jim, I'm sorry to interrupt, but I want to make sure that we can go through this before we run out of time. Is there trouble in CLO land, or does it, from the standpoint of a CLO manager like Apollo, do you worry about those structures and the underlying debt, or do you see that more of an opportunity to pick up the triple Cs that the CLOs can't buy anymore?
We look at it as an opportunity. I mean, certainly the ability, the role that CLOs played in the past is going to change. There's going to be a dramatic demand for private credit, and across the breadth of our platform, our $200 billion, we are looking to expand our avenues of private credit. We also announced on our call last week that we're in the process of raising over $20 billion of capital for a variety of dislocation and distressed strategies. So from our perspective, what's going on in the CLO market is an opportunity for a firm like Apollo, which is really a leader in alternative credit.